So, imagine you're running a company so incredibly massive that your daily operations account for 5% of your entire country's export income.
Right, which is just a staggering number to even wrap your head around.
Exactly. I mean, you're operating in 17 different industries, you employ 38,000 people, and you're bringing in 1.65 billion US dollars in annual revenue.
Yeah.
The question is, how do you steer a ship that big when the global economy just suddenly capsizes?
Well, it requires this incredibly complex financial architecture. And, when the waters get choppy, that architecture gets tested to its absolute limits.
Absolutely. So, welcome to the Deep Dive. Today we are bringing you a special Optivest Investing Sri Lanka Forensic Edition. We're looking at a subject whose sheer mind-boggling scale practically functions as its own ecosystem. We are talking about Hayleys PLC.
Yeah, founded way back in 1878.
Right, so they spent 147 years building this empire. But we have a stack of recent financial reports here, plus a brand new Colombo Stock Exchange announcement from January 21, 2026 that tells a very, very complicated story.
It really does. And today we're going to take a calm, data-led, forensic look at all of this.
No speculation.
Exactly. No speculation, just letting the numbers do the talking.
Yeah.
Because the core mystery we're unpacking today is this fascinating contradiction.
Yeah, let's get into that.
So on that January date, Hayleys announced a rights issue to raise 9 billion rupees from you, the shareholders.
Okay.
But when you hold that 9 billion rupees up against the company's massive 204 billion rupee debt stack,
which is huge.
it is. That 9 billion is only a 4.4% dent in the total debt.
Right. Which immediately raises the question that retail investors are probably feeling right now, but maybe struggling to articulate, which is 9 billion rupees enough?
Yeah.
And honestly, how did the debt get that bad in the first place?
Well, to understand the debt, we first really have to understand the sprawl of this company.
Right, because Hayleys PLC doesn't really have an identifiable parent company of its own. It sits at the very top of this massive corporate pyramid.
It is the ultimate conglomerate. I mean, you have Eco Solutions, Hand Protection, which is, manufacturing, rubber gloves, purification, textiles, plantations, leisure, transportation, and logistics.
It just keeps going.
Yeah, consumer and retail. It's a staggering 17 different business sectors under one roof.
I actually noticed in their earlier annual reports, they don't use like a machine analogy or a building analogy to describe themselves. They visualize the company as a forest.
Oh, that's interesting.
Yeah, and I actually love that analogy for you, the listener, trying to picture a conglomerate of this size. In a forest, you have all these individual trees. Those are the 17 different sectors. And above ground, their branches unite to create this massive shared canopy that basically sustains life and generates immense economic value.
Right. And if we look at the data, that forest analogy isn't just marketing, It acts as a structural hedge against disaster.
Oh, so?
Well, in corporate finance, diversity means that when the economic climate changes and one species of tree struggles, another one thrives.
Yeah.
Take the 2020 and 2021 numbers, for example. The world was dealing with the pandemic.
Right. Everything shut down.
Exactly. Their leisure sector, which includes all their hotels, was totally decimated. If Hayleys was just a hotel company, they would have been fighting for their lives.
Because they're a forest?
Precisely. Their hand protection sector, making medical and rubber gloves, saw a massive surge.
Oh, of course.
Yeah, and their purification sector, HAYL, which makes activated carbon, also thrived. So those strong trees held up the entire canopy.
That makes total sense.
Yeah, it's why they are Fitch rated AAA stable. I mean, on paper, they are Sri Lanka's most powerful conglomerate.
So the forest is extremely resilient. But, even the strongest forest needs rain. And in the corporate world, rain is capital.
Very true.
Let's talk about the debt, because a 204 billion rupee debt stack doesn't just appear overnight.
No, it certainly doesn't.
I'm looking at this timeline, and as a retail investor proxy here, I have to ask, did they just wake up one day and decide to borrow 200 billion rupees, or was this a slow build?
They didn't stumble into debt. They actively chose it.
Okay.
And they chose it to fund a massive decade-long expansion. If you walk through the acquisition timeline, every single move was logical in isolation.
Right. Let's walk through that.
So in 2010, they acquired the Kingsbury Hotel. That was a debt-funded diversification into leisure.
Makes sense.
Then we hit 2017, and this is a major milestone. They bought Singer Sri Lanka for 10.8 billion rupees.
Wow. And Singer is a massive consumer and retail brand. Did they use cash for that?
No, it was entirely funded by bank loans.
Entirely?
Entirely. It was the largest single acquisition on the Colombo Stock Exchange at the time.
That's bold.
Yeah, and if you look at their balance sheet, their debt quadrupled in the 10 years leading up to 2017.
Quadrupled.
Right. Finance costs rose from 0.8 billion to 3.8 billion rupees over that same period.
Okay, so the debt is clearly creeping up, but they are buying valuable assets.
Yes, and they didn't stop there. In 2021, they bought South Asia Textiles for 3.95 billion rupees.
Which makes Hayleys the largest fabric manufacturer in the country, right?
Exactly. Then in 2023, they took a 700 million rupee stake in Harana Plantations.
Okay.
Add in massive capital expenditures on top of that, building a new sports glove facility, investing heavily in solar installations, and a 50-megawatt wind project they were awarded in 2025.
So they're building an absolute empire.
Mm-hmm.
But they are building it almost entirely on borrowed money.
That's the core issue right there. By the 2024-2025 financial year, all of those isolated logical decisions collectively built a 204 billion rupee debt stack.
That's a mountain.
And a massive portion of that was variable rate debt.
Wait, hold on. Let's unpack that for the listener, because variable rate debt sounds like standard financial jargon, but it kind of feels like the villain of this story.
It really is.
What is the actual mechanism there?
Well, when you take out variable rate debt, the interest rate you pay isn't locked in.
Okay.
It floats on the ocean of the global and domestic economy. If interest rates are low, your monthly payments are low, you can afford to borrow really aggressively.
But if global interest rates spike...
then the cost of the money you already borrowed shoots up overnight.
Oh, wow.
You didn't buy anything new, your debt just became drastically more expensive to hold.
You know, I want to upgrade our forest analogy for a second.
Go for it.
If the 17 sectors are the trees, variable rate debt isn't just a heavy boulder sitting next to them. It's more like a parasitic vine growing up the trunks.
Oh, that's good.
Right. Because during a good year, with plenty of rain and low interest rates, the trees easily produce enough sap to feed themselves and the vine. But when a drought hits and interest rates spike, that vine suddenly starts drinking twice as much. The tree is still perfectly healthy, still trying to grow leaves, but the vine is just sucking it dry.
That is a highly accurate way to visualize it, and that exact drought hit them brutally in the 2022-2023 financial reports.
Right, because I'm looking at the timeline, and the whiplash is just severe.
It is.
In 21-22, they were flying high. Profit after tax had doubled to a record-breaking 28.10 billion rupees. Management was actively boasting in their reports about perfectly managed debt and lower interest rates.
Yeah, everything looked great.
And then literally 12 months later, the world just changes under their feet.
The macro environment turned completely hostile. Domestic and global interest rates spiked. And suddenly, that parasitic vine you mentioned started choking the operational cash flow.
Yeah, the 2223 reports, despite some of their sectors seeing 46% revenue growth, Hayleys saw its net finance cost, which is just the cost of servicing that debt, explode by 130%.
Unbelievable.
It jumped to 4.6 billion rupees. Tax expenses jumped 263%. And by the time we hit 23-24, their earnings per share plummeted from 21.80 rupees all the way down to 9.19 rupees.
And just to clarify for the listener, earnings per share, or EPS, is essentially the ultimate scorecard for a retail investor.
Right.
If you own a single share of Hayleys, EPS tells you how much of the company's total profit technically belongs to your one share.
So it's everything.
Exactly.
Yeah.
When it drops from 21 to 9 rupees, the fundamental value proposition of holding that stock takes a massive hit.
It's terrifying. You're watching a company actually increase its revenue, yet the shareholders are getting poorer because the bank is taking all the extra cash.
Exactly.
Which brings us to the 2024-25 recovery playbook.
Yeah.
And there's some good news here. They actually pulled off a bit of a miracle.
They did.
In the 2024-25 report, profit after tax surged 52% to 22.51 billion rupees. That was driven largely by transportation, logistics, and purification.
Right. But, as an Optivest forensic deep dive, we can't just clap at the top line profit.
No, we have to run the tests.
We have to run 3 specific forensic tests on those audited 2024-25 financials to see the reality beneath the surface.
Okay, let's dive into those.
Test number 1 is the return test. We look at group ROIC versus the cost of debt.
Okay, stop right there. Before you give me the numbers, explain ROIC for the listener.
Sure. Return on invested capital. It's a classic capital allocation framework, often championed by investors like Warren Buffett.
Right.
Think of it as the return the company generates for every dollar it puts into the business.
Makes sense.
The rule's really simple. Your ROIC must be higher than your cost of debt. If it costs you 7% in interest to borrow $1, you better be making more than 7% when you invest it.
Otherwise, you're literally paying to lose money.
Exactly.
So how did Hayleys do on the return test?
Well, at a group level, they passed. The overall ROIC is 13.52%, and their cost of debt is 7.43%.
Okay, that's solid.
So overall, the empire is accretive. It's creating value. But when you look tree by tree in the forest, the picture is super uneven.
Okay.
Purification is fantastic at roughly 20%. Singer is strong at 15.8%.
Right.
But hand protection, their rubber glove sector, has an ROIC of only 8.3%.
Wow. So hand protection is generating 8.3%, but the money costs 7.43%.
Right.
They are barely clearing the hurdle. If the economy shifts even slightly, that entire sector could turn negative.
Yes. The empire has clear winners, but it also has segments carrying massive structural risk.
Okay, what's next?
Let's move to test number 2, the coverage test. This looks at interest coverage. Essentially, how many times over can the company's operating profit pay its interest bill?
Right.
Hayleys sits at 3.06 times.
Okay, that sounds really healthy. They make 3 times more than they owe the bank every month.
Well, on an accountant's spreadsheet, it is healthy. But cash on a spreadsheet isn't always cash in the bank.
Oh, the classic trap.
Right. And here's the forensic catch. 39.79 billion rupees, which is 77% of all the operational cash the group generated, was physically consumed by inventory and receivables.
Wait, explain the mechanism there. What does that actually mean for the business on a random Tuesday morning?
It means they made a profit, but the money is tied up.
Tied up how?
It's sitting in warehouses as unsold washing machines at Singer, or unsold rubber gloves, or, it's sitting in receivables, meaning they sold the goods, but the client just hasn't paid the invoice yet.
Oh, wow.
So the business is earning profit, but it severely struggles to convert that profit into free liquid cash that it can actually use to pay down debt.
Which means the debt just sits there collecting interest.
Exactly.
Okay, hit me with test number 3.
Test number 3 is the resilience test. And I have to say, this is the most alarming number in the reports.
Okay, brace yourselves.
Of that massive 204 billion rupee debt stack, 132.75 billion rupees matures within 12 months.
I'm sorry, what? 132 billion is due in a single year.
Yes.
That's 65% of their total debt.
Yeah, they have a massive maturity wall approaching. And on top of that, you have structural currency mismatches.
Explain that.
For example, Singer earns its revenue in local Sri Lankan rupees, but it imports all those electronics in US dollars.
Oh, that's dangerous.
Very. When the local currency weakens, it costs more rupees to buy the exact same TV to sell. That mismatch alone resulted in a group foreign exchange loss of 3.15 billion rupees in FY25.
Okay, so this paints a completely different picture. We see the 52% profit surge. But beneath the soil, the roots are dealing with a 132 billion rupee maturity wall and severe cash flow bottlenecks.
Right.
This actually perfectly explains something else I noticed in the reports. Hayleys is dedicating massive, and I mean massive, sections of their reporting to ESG, environmental, social, and governance metrics.
Oh, they are leaning into it heavily.
Very heavily. I was reading these stats, and they are reporting a 68% reliance on renewable energy. They've invested 5 billion rupees in solar power alone.
Mm-hmm.
And they are meticulously tracking their carbon footprint down to the exact ton covering scope 1, 2, and 3 emissions.
Right.
And just as a quick refresher for the listener, that means they aren't just tracking the smoke coming out of their own factory chimneys, which is Scope 1.
Yeah.
They're tracking the emissions of the power plants supplying their electricity, which is Scope 2, and even the emissions of the ships transporting their goods, which is Scope 3. That is just obsessive detail.
It is, but let's connect the dots here. Why would a company staring down a 132 billion rupee short-term debt wall spend 5 billion rupees on solar panels?
Well, a cynic would say it's just a greenwashing PR campaign to look good in the annual report.
Sure, but forensically, it is a strict financial imperative. Remember, they bring in $685 million in foreign currency.
Right.
They compete on a global stage with Myers in the UK, Europe, and the US. Those international markets have increasingly strict supply chain mandates. If Hayleys cannot prove they are environmentally compliant with detailed Scope 1, 2, and 3 data, they risk losing massive international contracts.
So the carbon footprint isn't just about saving the planet. It's practically a ticket to even play the game globally.
Exactly. And let's take it a step further. The entire global financial system has shifted.
How so?
Access to institutional investment and favorable international loans is now heavily tied to ESG performance.
Right, of course.
By investing in solar, they aren't just lowering their electricity bill, they are mitigating risk to secure access to cheaper capital. It's a shield to protect their revenue streams.
Okay, that makes total sense. They are trying to protect the empire.
HAYL.
Which leads us to the absolute climax of our timeline today. January 21st, 2026. The Colombo Stock Exchange announcement. And it has a fascinating, really dual nature.
This is where capital allocation gets very, very interesting.
First, they announce a sweet reward for shareholders.
Yeah.
An interim dividend of 6 rupees per share. But in the exact same document, they announce a rights issue to raise exactly 9 billion rupees.
Right.
The mechanics are, they are issuing 45 million new shares at a price of 200 rupees each. Existing shareholders get the right to buy 3 new shares for every 50 they currently hold.
Yeah.
And the stated purpose, quote, for new investments and to fund part settlement of debt.
And this is the moment where we, as the Optivest proxy for the retail investor, really need to pause and ask the hard questions.
Right, because I am honestly confused. You just handed me a 6 rupee dividend with one hand. But in the same breath, you are asking me to reach into my pocket, buy more shares at 200 rupees a pop, and infuse 9 billion rupees into the company to pay off your debt.
It's quite the paradox.
Why hand out cash only to ask for a massive infusion of cash right back?
Yeah.
I mean, if we look at Professor Damodaran's frameworks on dividends, if you don't have the free cash to fund your obligations without going to the market, you probably shouldn't be paying a dividend at all.
It's a classic corporate duality.
Right.
By paying the dividend, they project strength and keep the stock attractive. The rights issue is the true reflection of the balance sheet's reality. And just to define the mechanism clearly for everyone, it's called a rights issue because existing shareholders are given the right of first refusal to buy these new shares.
Why does that matter so much?
Because when a company issues 45 million brand new shares, the pie gets bigger, which means your existing slice of the pie just got smaller.
Right, dilution.
That's called dilution, exactly. The company usually prices these new shares at a slight discount, in this case 200 rupees, to basically entice you to buy them so you can maintain your exact percentage of ownership.
It's literally subscribe or dilute. You either give them more money or your voting power and future earnings per share just shrink.
Precisely. And this leads to the 5 forensic questions Optivest is asking about this exact move.
Let's hear them.
Question 1. They say the 9 billion is for part debt settlement and new investments. But the split is completely undisclosed. How much is actually retiring debt and how much is just funding more expansion?
That's a huge distinction. If they're just taking my money to buy another company instead of paying down that 204 billion rupee vine that's choking them, the risk profile hasn't changed at all.
Exactly.
What's question 2?
Question 2 is about the math. At a 7.43% cost of debt, taking 9 billion rupees to pay down loans saves the company about 669 million rupees a year in interest. But that is only 4.3% of their total finance costs. Meanwhile, shareholders are facing a 6% dilution.
Oh, wow.
Is that a fair trade? You suffer a 6% dilution for a mere 4.3% reduction in interest?
Yeah, that math does not feel great for the retail investor.
Yeah.
And it feeds right into question 3, which goes back to your resilience test earlier. You said 132.75 billion rupees of debt matures in the next 12 months.
Right.
This 9 billion rupee rights issue covers exactly 6.8% of that wall.
Yeah.
What happens to the remaining 123 billion rupees?
That is the elephant in the room. Do they just roll it over into new, potentially higher interest loans? We don't know.
Right.
Which brings us to question 4. Retail investors who bought into Hayleys during its previous peaks might already be underwater on the stock.
Yeah, losing money on paper.
Now they face this subscriber dilute mandate. Who protects them? I mean, they were being asked to rescue a balance sheet they didn't over-leverage.
It's a tough spot. And the final question.
Question 5 is the ultimate structural query. Is this rights issue a sign of proactive de-gearing, like management wisely fixing the roof while the sun is shining after a 52% profit surge?
Right.
Or is the balance sheet finally dictating terms, telling management they have absolutely no choice but to exchange debt for equity?
Wow. They are trading debt, which is an obligation that carries a mandatory interest rate and can literally bankrupt you, for equity, which is capital that is permanently theirs even if it dilutes us.
Exactly.
It's a brilliant move for the survival of the forest, but a really tough pill for the individual investor holding a single leaf.
That is the perfect summary.
Let's zoom out and recap this incredible journey for you, the listener.
Yeah, let's bring it all together.
We've watched Hayleys PLC leverage its 17-sector forest to survive the initial pandemic boom. We saw them suffer through the brutal interest rate whiplash of 2023 when that parasitic vine of variable debt chokes their earnings. We saw them bounce back with a 52% profit surge in 2025 while using ESG as a financial shield to protect international contracts.
And finally, we saw them move to shore up their foundation with a 9 billion rupee rights issue in 2026.
The empire stands, the Fitch AAA rating holds. But 9 billion rupees against a 204 billion rupee mountain of debt is not a complete solution.
No, it's not.
It is just the beginning of one. And retail investors deserve to know the difference between a minor repair and a structural overhaul.
The data doesn't lie. Whether you act on it, well, that's entirely up to you.
Thank you for joining us for this forensic deep dive into the massive ecosystem of Hayleys PLC. Keep questioning the numbers behind the headlines. Remember to look past the canopy to see the roots, and we'll catch you on the next one.
See you next time.
And as a quick reminder, this deep dive is for educational purposes only, based entirely on public data. This is not investment advice. Optivest focuses on clarity through data-driven analysis. Stay tuned for more.